So to start off, when private equity firms provide financing to venture capital firms, what you need to understand is that they usually base those financings in form of what we call rounds. So if we have, say, this figure right here, here we have the investors, here we have the PE firm, and here we have portfolio of companies like that. Before the PE firm provides financing to the portfolio of companies right at this level over here, they usually base it on milestones. Say, for example, if the private equity firm wants to provide financing to this company via X, they could be able to provide them some objectives so that they can be able to achieve, and then once they achieve those objectives, they can be able to receive the second round of financing. So, for example, probably the private equity firm, maybe the total input into this firm would require maybe 5 billion shillings like that. So what it can do, it can specify some objectives like that, and then it provides the first financing round, which will be totaling to around maybe say 1.5 billion. That's the financing round, and then they set another set of objectives like that, which they provide 3.5 billion like that for the second round of financing. So they provide the first round of financing 1.5 billion, the second round of financing 3.5 billion, totaling now to the entire 5 billion. So those milestones is what we're saying represent the terminology here that I'm using, rounds there. Now, to compute the pre-money value, post-money value, ownership fraction, and price per share, we will first of all consider single financing round. So single financing round there. So what we'll do, we need to have a set of formulas that we need to recall here, very simple formulas. So if you recall, we had said pre-money value plus INV. We had looked at it in our previous lesson, gives us post money value. Now, post money value is given as the present value of exit value there. So what we're saying is this: we are just going to say it is just the exit value divided by 1 plus R power n. That is what you're saying is post money value there. Now moving on, getting the fraction of the venture capital ownership. So F, which you're saying, I'll be able to describe all of these. F, which you're saying is the fraction of the venture capital ownership. So fraction of the venture capital ownership, like that, is given as, so we say F is given as investment value over post money value. We had already explained this in our previous lesson. However, I'll be able to explain what that. So we are saying, and we can be able to provide some brief descriptions right down over here. We can say pre money value, or money prior to capital infusion, pre-money value. Then we're saying post is post money value. Then the exit value is the value upon exit. So exit value is value to be earned upon exit, like that. Then F, I've already explained, is the fraction of the venture capital ownership there. Now we can move on and look at how to compute the venture capital shares, or shares VC, which you're saying is given by the shares provided by the founders, then you multiply that by F, which I said is the fraction of the venture capital ownership there, F over 1 minus F there. Remember, we are still dealing with a single financing round. We will be looking at an example that can be able to highlight or demonstrate how to apply this. Now, from there, now we need to get the price per share. Remember, our guide should be this title over here, the pre-money value, the post-money value, ownership fraction, and price per share. So this is the ownership fraction right over there, and we are talking about now the price per share. So price per share is given as the investment value, INV over, not over post, but over shares VC for the venture capital, that value right over there like that. That is for a single financing round. Now, let's move on to how we can be able to demonstrate using an example these values over here like that. So we have an example there given to us. It reads as follows. Ponder Technologies is a biotech company. Ponder's entrepreneurs believe that they can sell the company for 40 million in 5 years. They need 5 million in capital now, and the entrepreneurs currently hold 1 million shares. The venture capital firm, VC investors, decides that given the high risk of the company, a discount rate of 40% is appropriate. Calculate the pre-money value, the post-money valuation, ownership fraction, and price per share applying the NPV venture capital method, single financing round. These are the steps that they want us to use. So we are saying they want us to calculate the pre-money value. So in the first step, we have the post-money value is just given as the exit value discounted against 1 plus R and power n there. So the first thing for us to do is calculate the post-money value. So we just say solution there. The post is given as the exit value divided by 1 plus R power n. Then you're saying the exit value in this case, we are being given 40 million there. So it's 40 million like that, discounted against 1 plus the required return in this case is 40%, 0.4. How many years upon exit? 5 years there. So how much is the post-money value there? So the post-money value is 40 divided by 1 plus 0.4, 1.4, that's 1.4 power 5. Power 5, we're getting 7.4373. 7 million 437,377 like that, and 7.2, can put it like that, 0.2. That is the post money value. From there, and we be able to get the pre-money value. We have the pre plus INV is equals to post money value. Remember, the pre plus INV is equals to post money value. So can we be able to get the pre-money value? Yes, we can get the pre-money value. We just move the investment value on the other side. So we are saying the pre is given as post money value minus INV, which we are saying now the pre-money is the post money 377 minus the investment value. We have an investment value of how much? We are being told that they need 5 million in capital now. So 5 million. So 7 minus 3 looks like 2 million. So 2,437,377.2 there, like that. So that is the pre-money value. Now we've already gotten the pre-money value. Now the next thing is for us to get the ownership fraction, the F value. Now we can see the F value is given as investment value, or the fraction of the venture capital ownership is investment value over post there. So I can come on this side. F is the investment value over post. So we have F is given as INV over post, which we're saying the investment value is how much we have it there, 5 million, over post value. The post money value is how much? The post money value is 7,437,000. So 7,437,377, 377.2. So how much do we get from there? So 5 divided by 7,437,377.2, 0.67, 0.6723, or we're saying 67.23%, and that is the VC shares, rather the fraction of the VC owners. Yeah, so we're saying this is 67.23%. From there, can we be able to get the shares of the venture capital or value, the shares of the venture capital, which you're saying is the shares VC right there, and we can be able to get that because you're saying, and we already have the component of F given to us. F is 0.6723, and 1 minus F is there. The shares of the founders we have been given in the question there. In the question we have been given as 1 million shares there. I can see 1 million. So can we be able to get the shares for the VC? So shares VC, or venture capital shares, is just given as the shares founders 1 million, multiplied by F. We already have the F here, 0.6723 over 1 minus 0.6723, like that. How many shares are due to the venture capital holders? So we can first of all work out this 0.6723 divided by 1 minus 0.6723. We have 2.05 multiplied by 1 million multiplied by, we have 2,051,000 shares. So we have 2,051,572. We can put like that, shares, because you do not have 0.5 shares there. Once we have the shares that are due to the venture capital owners, can we be able to get the price per share? We have got the investment value over the shares VC. These shares VC, or the shares that are due to the venture capital owners, are those number of shares. We can be able to get the investment value. So the investment value which we've been given is 5 million. So we have price per share is given as the investment value INV over shares VC. Shares VC, which we are saying the investment value is 5 million, divided by the shares VC, which we're saying is 2,551,000, 2,051,572, like that. So the price per share is how much? So 5 million divided by, answer is 2.44 per share. 2.44 per share. Those are the steps for a single financing round.